Good morning. Welcome to the show. Here we go. It's 9 a.m. here in Hong Kong, in Beijing and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne Man.
Our top stories this morning, Premier Li Keqiang, I should say, says China's economy grew around 5.2% last year, surpassing the government's target. Sources say Beijing is now considering fresh stimulus via special bonds. Traders paring back bets on Fed rate cuts as Governor Chris Waller warns of a cautious approach, the dollar jumping the most in 10 months, and the greenback strength taking the Chinese yuan towards 2-month lows as President Xi emphasizes his desire for a strong currency. And we're watching that fix very closely here today, not just because of how cheap it is, I guess, the offshore is against the onshore, as you're going to talk about, but really this data dump and a little bit of preview that we got from the premier yesterday in Davos. Yeah,
today's headlines yesterday.
Who would have thought?
Yeah, 5.2%. And, well, I guess it should not be surprising if that is the growth clip we get. Perhaps pushing it forward is if we did get better than expected growth last year, is at a higher base, right?
Yeah.
To hit a 5%, more difficult, I guess, to hit that growth target that we have yet to hear from, by the way, this year. Okay, well, it takes us straight into markets right now. Yvonne was talking about the renminbi fix for the day, perhaps more important than usual, maybe as an anchor amidst this rampaging U.S. dollar. We have home prices coming out this hour. We have, in the next hour, of course, it's a data dump, GDP numbers as well. With the exception of Japan, which continues to just hit new highs in at 36,000, we're now about maybe 0.5%, if not slightly more, before we hit that December 29, 1989 high on the Nikkei 225. We're called lower on A50 futures. Flip the boards, please. You had some data coming through out of Singapore. We have a rate decision out of Indonesia. Today, no change expected there. Weakness, as you can see, permeating across these markets coming online. Commodity markets, last I checked, we were steady. We were steady in oil prices yesterday amidst, despite the further escalation we're seeing in the Red Sea. The action, though, has really been in the bond markets where, well, for one, high-yield dollar bonds, I think, are up every single day. This is Chinese bonds here, going back to December 11th. So we haven't had a down day so far as that group is concerned. Bond auction today in China. We have a narrower gap between the 2s and the 10s in the U.S. We're 407 handle now on the 10-year there. And the currency markets, we talked about the dollar's best move or biggest move since March of last year. I think it's the 200-day moving average in focus in the Aussie, 100-day moving average on dollar Japan, and of course dollar China has blown through, I think, the 250-day, which takes us, as Yvonne's point, we're not trading at the cheapest level here on the offshore currency relative to the onshore currency, going back to, I think, August of last year.
Yep, so we'll see, right, how this all plays out, whether we're going to see a stronger fix to try to anchor things in some ways. You take a look at where that kind of gap is looking at
massive,
right now.
Yeah.
It's a massive gap we haven't seen in what, a few months from now, Dave, right?
Since August of last year.
Yeah.
Which, by the way, is also to say that this level of this gap has proven unsustainable. So it depends really what the fix looks like out of the PBOC today. There we go.
And of course, we're all kind of digesting and thinking about what's to come here after those comments from the Chinese Premier Li Keqiang saying that economic growth surpassed the government's target in 2023, speaking in Davos ahead of the release of those official growth figures.
Last year, in 2023, the Chinese economy rebounded and moved upward, with an estimated growth of around 5.2%, higher than the around 5% target set at the beginning of last year. In promoting economic development, we did not resort to massive stimulus. We did not seek short-term growth while accumulating long-term risks.
Let's bring in Jill Desus, our China economy editor. Yeah, I think we're all watching and tuning into this speech, but then when he brought out this number. I think everyone was pretty shocked, right?
Yes, I mean, look, he's kind of spoiling the news that we've got, ahead today in just the next hour. I can't really recall a similar incident of a premier doing that. I know that former Premier Li Keqiang a couple of years ago during the pandemic had kind of intimated a few months before they actually announced GDP that they were on track for the year. But yes, I think, a bit surprising there. But maybe what it does is it's projecting that idea of confidence to this global community in Switzerland, kind of saying, look, last year is in the bag. We're focused on this year. I do think that probably the biggest takeaway from that speech you just heard there is the fact that he said they were able to achieve this target without relying on massive stimulus. Now, of course, we know that China did roll out some forms of support last year, including some rate cuts, some cuts to reserve requirement ratios. They did have that mid-year budget revision involving the additional issuance of some sovereign debt. But ultimately, yes, I think his point is that we're focused on risks for 2024, and we're able to achieve the targets that we've set out for ourselves without, accruing a ton of debt or putting ourselves into trouble there.
But also because of good base effects too, right, Dave?
Oh yeah, we're coming off a reopening as well, which we won't have actually going into next year, right? Yeah. This is a relatively higher base as well. And to your other point, they're using the budget. What do we know about this Bloomberg scoop now on them looking to increase their leverage on the central bank balance sheet, central government balance sheet?
Yes. So ultimately, what we're reporting here is that the government is considering the issuance of this additional special sovereign debt that wouldn't. They can obviously change sort of how exactly they want to move some things around the balance sheet, but traditionally, special debt does not actually affect that headline deficit ratio. So the issuance that we saw last year, that sovereign debt that was announced in October, part of that really rare mid-year budget revision, that was part of that contributed to the headline deficit ratio. That's why you saw it rise to 3.8% in 2023. I think, though, look, the number that we're reporting here, it's about 1 trillion yuan, so around 140 billion US dollars. It's not a giant number. So I guess to Li Chang's point, that's not massive stimulus in terms of this giant overall number. But what I do think that it points to is this idea that there's been something of a sea change in how the government is looking at deploying stimulus and how they're trying to shift some of these debt burdens around. Remember, this is central debt, right? So we're seeing that shift away from saddling a lot of these really debt-laden local governments with a lot of the spending burden, more toward taking on some of the responsibilities, the central government. We saw a bit of that last year with that mid-year budget revision I just mentioned. Maybe that's something that we're going to see a bit later this year as well.
Jill, thank you so much. Jill Deesis there, our China economy editor. Let's bring in our guest this hour. First guest this hour, Jinyue Jie, multi-asset solutions investment specialist at JP Morgan Asset Management. Good morning.
Morning.
Is there anything that you heard there from Jill that convinces you that China's now a buy?
Well, we do think that, China right now, the valuation is actually not expensive and the position is light. So any positive news, that could be giving China some scope to rally from current level. And if there's more easing from the government, and plus, the previous easing starts to actually feed through the economy, that's actually a plus for China. But the key ultimately is really, the confidence in consumption. I think that's something that we should closely monitor.
But it's been cheap valuations have been cheap all year round. I'm just wondering, is drip stimulus still enough, right? I mean, we've seen basically beyond just emerging out of COVID zero, everything has kind of disappointed to this point.
Yeah, that's valid, and we do think that some of the reasons is coming back to essentially two reasons, right? One is the confidence in consumption. Right. That's where we do need to see release of the excess rate saving rate and also improvement in the job market. Those are kind of the two key things we need to monitor. But also, I think another key area to watch is the property sector. Yeah. And we do think that the drag from the property sector could potentially start to moderate. And that's also the reason why we are actually currently neutral on China and looking for opportunity to add to China.
Right. Is it also the case that the alternatives to China are just more compelling right now? So whether it's in equity markets, whether that's the U.S. or Japan, or we look at fixed income, for example, that's really where you are in duration, for example, which have, yields have room to fall even further.
Yeah, so we do have a positive view on equity in general, but mostly, I think, in U.S. large cap and also Japan. And on duration, we also have a constructive view, and we do think that rates do have rooms to obviously fall down, and that will provide a really positive backdrop for duration.
But it's interesting that you mentioned, though, the stock and bond correlations, right, where they've basically been positive for much of last year. It's still going to stay positive, you think, but in some ways it's going to be better when it comes to how investors look at risk, equities in particular, too.
Yeah, we agree. I think stock-bond correlation will probably remain positive, at least in the first half of this year. But this time, I think that will work in our favor because stock and the bond will likely to appreciate at the same time. But going beyond this time frame, with cut rates, Fed start to cut rates, we do think the correlation will start to come down, towards neutral or even become negative, beyond this year.
Yeah, in fact, we heard from, I think, Christopher Waller from the Fed, the latest official to, I guess, in some ways push back against market expectations that they're going to cut rates in 2 months' time. In fact, let's listen into that, guys, please, if we can.
With economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past.
I guess the question is short term, if 6 cuts are too aggressive, does that mean the dollar has ways to go up and yields have ways to go up over the short term?
Well, our view has always been that I think the market expectation of 6 cuts and starting from March is too aggressive. Okay. We do think that Fed will likely to start cut in the middle of this year and probably 4 cuts this year. So we are slightly, I guess, less aggressive in terms of our expectation. And I think if you look at U.S. dollar, that obviously the recent move also shows that market expectation is also being adjusted, which is kind of coming back to, the point of what, the Fed is trying to make, that with the easing financial conditions, I think they're trying to be more prudent and careful in terms of how they want to coordinate, the whole kind of rate cut cycle.
How are you looking at credit here right now? I know you're looking maybe even into high yield in the U.S. I mean, spreads are pretty tight right now. What assumptions are you making on growth then?
So we are constructive on high yield, U.S. high yield. That's more for carry rather than for kind of the spreads. And we do think that given our base case scenario is that there's not going to be a recession over, I guess, 6 to 12 months, all in carry is actually quite attractive at this moment.
So, to clarify, that's all in yield?
Yeah, all in yield.
Okay. Well, does a recession change that view, I guess? If increasingly it looks like a recession has a high probability, do you want to get anywhere near high yield in the U.S. is my question there, even with the all-in yield that you get on the table right now?
I guess everything is coming down to fundamentals, right? I mean, I think our view right now is the recession probability is relatively low, around 20%, which is only, I guess, slightly higher if you look at the long-term realized rate. But having said that, also the other important aspect on this is the quality in high-yield space has really improved over the last few years. And that would really help the default rate, to remain low for this year, as long as the recession is not really a real case scenario. Okay. Yeah. But if macro data starts to deteriorate, let's say, that's a small probability chance. But I think if that does happen, we probably need to be more careful around that.
Okay.
Yeah.
We've got to talk about Japan. As we had a glimpse of what you favor in terms of equities. What does this next leg of this rally look like? It seems like we're regaining some momentum again to start the year.
Yeah. So Japan is one of our kind of more positive area within the equity space. And I think that's really coming down to, the longer term trend where, the corporate reform is really kind of, providing a supportive backdrop for Japan equity. But also if you look at, the underlying wage growth, that's really kind of also provide another positive backdrop. So overall, we do have a more positive view on Japan equity.
Okay, is that a Nikkei play? Is that a topics play?
Well, I think for us, we don't really kind of try to really differentiate the sectors per se.
Okay.
I think overall, it's really the overall Japan kind of fundamentals that we really like.
Okay. Jin Jie, thank you so much. There we go. And I think if you bought both indexes, you would have done very well anyway, right? Topics index, in fact, at these levels. So the Topics is, in fact, now just doubled from that low in the pandemic, which is quite a juxtaposition when you look at the Hang Seng China Index, which has actually halved from its post-pandemic peak. Anyway, 15 minutes away from the fix of the day. This is going to be fairly consequential.
Yeah, you know, you take a look at what we're seeing in terms of the estimates is for 7.1953, just as we talked about, just this gap that we're seeing with the offshore and onshore rate. We might see a little bit more of support that comes through from the central bank here today. And certainly we're seeing a renminbi at 2-month lows right now for both of those. So certainly what this all means is certainly one. And, and what was the estimates for tourism in Lunar New Year? They were talking about, I don't have the number, but they said it was going to be explosive.
Yep.
So that could add some more weakness to the renminbi.
Well, I mean, some of the, one group of stocks, it's done very well amidst this bear market. Local tourism-related stocks have done very, very well this week as well. Okay, here we go. 7.1168 against the U.S. dollar, and that is where you are relative to estimates, a substantial gap, which should be unsurprising given the dollar China is pierced through 720 like a knife through butter. There we go. And that's ahead, of course, of some key numbers coming through, first of which in 15 minutes from now would be the home price numbers coming through for the month of December.
Then you got GDP, the whole data dump, 30 minutes after that as well.
Non-breaking news at this point.
Yeah, the spoiler alert. Thanks, Premier.
Yeah.
All right, makes our show less interesting, but we'll still make it interesting.
We'll do our best.
Coming up on Bloomberg, we have Alliance Bernstein. John Lin can make us more interesting. Joining us as we get the latest home prices out of China. And then, of course, Morgan Stanley's Robin Xing reacting to that data dump coming up at the top of the hour. We're also going down the opens of trade in Shanghai, Shenzhen, and Hong Kong. Futures are looking like this here right now. Oh, it's a beautiful day.
Lovely.
Out in Hong Kong. Crisp. Futures, though, slightly lower. This is Bloomberg Markets, China Open. Good morning. All right, we're taking a look at when it comes to futures. Still seeing some pressure here across China as we count down to not just the market open here today. We have home prices, new home prices coming out, as well as that data dump. So a little bit of caution as we head into the bottom of this hour. You're taking 252 for your Chinese 10-year yield, and that weakness in the renminbi is stabilizing a bit here. We had a much stronger fix than expected from the PBOC.
Yeah, 7.11, 7.12 handle on that. Speaking of China, the CEO of South Korean battery giant LG Chem says that they are hopeful about a progressive demand recovery there in China. That's despite what they see as a gray outlook for the petrochemical sector this year. We spoke exclusively with the CEO in Davos. Have a look.
It's quite well known that petrochemical is going through some kind of challenging time right now. If you look at the global capacity exceeding the global demand, and global demand is not coming back as strong as we might have expected, especially after COVID, especially from Asia, and particularly the Chinese demand is not coming back as strong as we expected at a time when global capacity continued to expand. So there's a little bit of imbalance between global supply and demand, which causes some temporary trouble, which we have seen before. So I'm not overly worried about it, but if you ask me what's the prospect of petrochemical, I think it's generally gray this year, maybe throughout the first part of next year.
When do you see China's recovery coming back and hence, boosting demand for petrochemicals?
Yeah, we hope as soon as possible. I'll keep my fingers crossed.
Would 2024 be the year?
Well, I think Chinese New Year, or Chunjie, is coming up. Hopefully, that one, and maybe some more events in China, which will trigger people to spend more money, basically. It's not the lack of money. People have money there, but they don't spend as much as they used to because they're worried about lots of things. Real estate bubble, they're worried about general economy, they're worrying about war, inflation. So I think generally speaking, Chinese domestic economy is big enough to sustain its own domestic cycle, but I hope Chinese people can spend a lot more money this year and next year. So I think the prospect is not any steep recovery in demand in China, but it will be slow recovery, but it is quite certain that it will be better going forward in China in terms of demand.
LG Chem CEO Hak Chil-shin there with Bloomberg's Linda Amen in Davos. Some of the stories that we're tracking for you this morning, we've learned European Commission President Ursula von der Leyen and Chinese Premier Li Keqiang raised their respective EV and liquor investigations during a meeting in Davos on Tuesday. But a source says there was no further discussion. China announced an anti-dumping investigation into some EU liquor products this month. The move was seen as retaliation for the bloc's scrutiny into Chinese EV subsidies. And China's state-owned banks are tightening curbs on funding to Russian clients. That's after the U.S. authorized secondary sanctions on overseas financial firms that aid Moscow's war effort in Ukraine. Sources say at least 2 lenders ordered a review of their Russian business in recent weeks, focusing on cross-border deals. We got plenty more ahead and your agenda coming up. This is Bloomberg.
Right. If you guys want to focus in on the positive news, I guess, at least here in Hong Kong, look at the weather, don't look at the markets. It's beautiful out there. Apart from that, when you look inside and the levels at which this index is set to open at today, I mean, we're set to open below 16,000 for the first time since 2022 on the Hang Seng Index. So, yeah, brace for losses at the open.
Yeah, I mean, we're already at 14-month lows. We're getting closer to that pre-announcement of exiting out of COVID zero, right? So we're close to basically fading or at least losing those reopening gains. So certainly that's one to watch here. You're already seeing quite a bit of pressure in the pre-market. We're down about 0.8% in 8 shares. We're taking a look in terms of analyst actions here today. So we're focusing on the airline space. China Southern, A shares cut to reduce at HSBC. Also, CLSA looking a little more at some of these consumer food-related stocks. Uni President and Ting Yi both cut to reduce from the firm.
Other things we're tracking today, all roads lead to either bonds or that concentric circle that overlaps with property markets. So this route in property stocks down over 3% yesterday. Home prices are coming out in a couple of minutes. Also in property space, this high-yield bond rally that's now taken this to successive weeks as well. We'll talk about the data in a moment. There's also a government bond sale today, 1 in 10 year, and that comes amidst these expectations of perhaps more ultra-long bond supply coming to hit this market. Yep,
new home prices come out in the bottom of this hour. We'll see how the property market fares here after we saw still continued declines. Despite that Ping An list that came out yesterday, we'll have plenty more to come. This is Bloomberg.
Chinese economy can handle ups and downs in its performance. The overall trend of long-term growth will not change.
Right, that's really setting us up ahead of the open and ahead of the release of, in a few seconds, the home price numbers for December, and of course in about 30 minutes from now, the big one, GDP numbers plus activity numbers coming through, unemployment rate and everything in between.
Yep, you already heard from Li Qiang there at Davos, 5.2%. He's thinking estimated for last year growth. So gave a little bit of a preview of what's to come in the next half hour or so here. Take a look when it comes to your open. It is seeing still downside when it comes to Hang Seng as well as your A50 futures here this morning. And we'll see how this whole scoop from us about these special bonds are going to change things, if any. But yeah, you continue to see a down arrow story. HS Tech has continued to see that downfall of 1%. 8 shares are down in similar measure. You have crude flat this morning. CGBs are slightly just flat here this morning as well. But it really is what you're seeing is the Hang Seng that continues to see most of the pain. We're down 0.8%. So it's the first time we've seen sub 16,000 opening.
Yeah. Since 2022, pretty much. Since we were in that, I think we were talking about this during the break. This that massive week that went from the low in October 2022
Yes.
and then hints of a reopening that sent this rally up. There we go.
We got new home prices coming out.
Oh, that's a bad number.
So it is a bad number. Falling 0.45% month on month. So that is a bigger decline than what we saw in the previous month. And this does mark, I believe, the 7th straight month that we have seen new home prices in contraction. So I'm guessing property stocks, that route may continue here today. We'll see. But yes, even yesterday we had the scoop about Ping An Bank coming out with a list of builders, 41 in total, that they can maybe extend lending to, including even Hong Kong developers. That really didn't change too much of the picture in terms of stocks. There was a bit of a bid and cost some of the bonds when it comes to developers here. But yes,
bonds, yeah.
This latest news, that drop in new home prices faster than November. I think the property market's still a key uncertainty for this year, Dave.
Absolutely. Underscores everything that we've heard recently, right? So whether that's the PSL,
Yes.
that's the Ping An Bank story and
Yes.
this funding list, that's, some of the reporting around perhaps more ultra-long bonds, shoring up this market. So context here, right?
Yeah.
Negative 0.5% month-on-month declines, close to that, is the worst drop. Is the worst drop going back to 2015.
Yep, all sectors in the red here right now when it comes to Shanghai, mostly. If you take a look at consumer discretionary, that's where you're seeing it down on 1.5%. Developers there on the right corner, that's where you're seeing still continued downside. Let's take a look at that, see if there's any reaction to these disappointing numbers that we got. And you take a look at, we split into two, right? So these were some of the banks, the Ping An Bank listed ones that were part of this list.
Yep.
So the likes of China Wanke, China Overseas, but there you go. We're still seeing downside. Long four is down some 3%. And you take a look at what we're seeing on the ones that were not on that list, which really dropped quite heavily yesterday as well. I'm guessing we might be seeing the same story here today. Renminbi, we talked about the 2-month lows. We broke above 720. Mark Cranfield from our MLive blog saying we're heading into this sort of new trading range as we get closer to the Lunar New Year. Not just because we have so much liquidity that's being in the system, but also you have yields in the U.S. that are continuing to pick up here as well, and of course the dollar moves that we've seen overnight.
Yeah, the repricing of a stronger dollar will certainly put much pressure on that. And to Yvonne's point on injections here, the PBOC, in case you guys missed it, out again with quite a substantial injection today, 527 billion, that's renminbi, in open market operations. That's on top of the nearly 700 billion that we had yesterday as well. Now, back to the property story, down the most, December prices overall, 70 cities, down the most since 2015. Are we getting enough policy offset right now? So you talked about this Ping An story, well, the Ping An Bank story and the funding list there.
Yeah, at least this came out yesterday, mind you. So yeah. We already did see some of the reaction yesterday across these markets. But it certainly, it just goes to show that this continued support is there. Whether it's enough is one thing. And we're likely to see maybe other banks do this, right? If we actually see, some of the bigger banks, what they're seeing in terms of, and of course they do have a heavy exposure to the property market, so certainly this could be quite telling how this plays out. But it's a bit different to what we saw in that so-called whitelist that we've been reporting last year as well. There were some differences in what was included and what was not.
Just to add to that too, this is also an observation we've made recently, is while the equity market can't find a floor in property, we just showed you that 3% drop yesterday, you have a further drop today. Junk dollar bonds have done exceptionally well, so they have gone opposite ways. We're up, I think, 7 or 8 weeks in the last 10 or 11. We're up every single day on the high-yield bond index going back to December 11 or so. So there have been some bottom fishers. That depends, of course, on your risk appetite, because that's an extremely risky part of this bond market. But just to note as well that while the equity market perhaps hasn't found a floor, there might be a floor forming in that part of the bond market. Let's begin back to equities now. Joining us out of Singapore is John Lin, CIO at AllianceBernstein. John, Happy New Year, and nice to speak with you, sir. This market can't find a floor. Where's the bottom?
Well, good morning. Good to see you, and David and Yvonne. It's hard to say. The valuations are extremely cheap on the equity side. And as you mentioned, some of the other asset classes like the junk bonds are doing much better. And so my colleagues across the floor from me in the fixed income side are having a better time. But what we're seeing this year so far really is a continuation of what we saw the last year. The economy continues to slow. And on the back of both the determined efforts by the government to continue to delever the property sector, and I think other actions like the resumption of anti-corruption campaign, etc., on sectors like healthcare or banking, that certainly didn't help growth. And of course, the authorities or policymakers were fairly reluctant to bring in the big guns when it comes to the stimulus. So sort of these squeezing the toothpaste type of stimulus policies so far haven't been able to turn around the underlying bottom-up fundamentals of areas like the property sector. And I think that's the reason why the property sector really hasn't been able to find a floor just yet, despite how cheap it is.
For a value investor like yourself, though, are you seeing more opportunities out there?
Yes, we are. So what's interesting, what we're seeing in the Chinese market or Chinese economy, really, it's a two-speed economy. The part of the economy that's related to property, and it's a big one, right? Property, by some accounts, are something like a third of the overall economy before the shrinkage that's taken place in the last 2 years. But outside of the property, whether it's in parts of the consumption sectors or in particularly industrial manufacturing areas, some companies actually are doing quite well. I think you've seen some numbers when it comes to domestic travel trips that are planned for the Lunar New Year coming up. That's one instance. And some of these industrial companies, particularly the ones that have developed a very nice niche industry leaderships in their respective areas, like bus makers or forklift manufacturers that have an export business to places like Southeast Asia or the Middle East. They're actually doing quite well, and these stocks are generally up in 2023, and they're up so far in 2024. But they are not that big part of the market overall, which is why I think the index overall is still under pressure.
Absolutely, it's the tailwinds aren't hitting the bigger part of the sail, as they say, in this market. What are value traps right now? As you look at everything that almost looks very cheap, what are you cautious on still?
Yeah, so what we're looking at the stocks is not just how cheap it is, because if that's the case, then you will find our entire portfolio being loaded up with property developers, for example, and that's not the case at all. We don't own any. But the what matters really is the earnings growth that one could conceivably forecast down the road. And so some of the value traps are, in fact, in areas that are related to the property sector. And I think, if I take a step back, what you're seeing in the Chinese economy, what we view this is really a transition, right? A transition away from the historical, the leverage-dependent growth model toward one that is more like the rest of the East Asian economies today, the Taiwan, the Koreas of the world. That transition process is painful, and it was painful for places like Taiwan and Korea. But the nature of the transition is that parts of the economy is going to go away. And then precisely those companies, property related, some of the really old manufacturing sectors that are pumping out goods that are really not that much value add, I think those are what we view as value traps. And that's why our attention is squarely away from those areas in areas that I think, in value-added manufacturing and parts of the consumer space, for instance.
And what's funny to your point there, John, is that despite this transition and the difference in the makeup of this economy, almost at the start of every year, the sell side attaches a 14-15% earnings growth to this market. So I'm wondering right now, it's still 14%, by the way, looking at 2024. Can I believe that number, since you talked about an earnings as being key here?
No, I think that's too high. And in fact, I don't think this is a current market phenomenon. And we have a chart that goes back to 2003. And every single year since 20 years ago, it's been that way. You start a year with a sell side relatively high, whether it's because sell side analysts want to curry favor with the companies they cover or otherwise, and it gets revised down toward the end of the year. And what matters really to the market is how much it gets revised down. So it's not really unique phenomenon for this year.
I know you're looking mostly at some of these industrial companies, the so-called boring stocks, as you say, John, which is kind of your bread and butter, the value space. But you're looking maybe at the healthcare sector very closely, which is more growth-oriented. I'm wondering why.
Yeah, indeed. The clients ask me, John, aren't you old-style textbook value investors? Why are you looking at healthcare companies? Well, the thing about healthcare companies, although they've done extremely well in years like 2020, COVID years, and reached really high valuation levels, in the middle of last year, there was this anti-corruption campaign, particularly targeting the procurement of pharma products and drugs. And so that caused really a pause or a freeze in earnings in a lot of companies in the healthcare sector. And what you saw in terms of valuation is a lot of those stocks have fallen a long way. So the valuations are getting really cheap. So from our point of view, when the market really doesn't like something, and invariably they are babies that get thrown out with the bathwater. And that's why you find us out there trying to catch some of these babies. And today we can find that in the healthcare sector, places like medical devices makers or pharma distributors, they are really getting interesting for us.
Yep, it's just distinguishing between the babies and the knives, isn't it? John, great stuff. Thank you so much.
What an image.
Yeah, catch one.
Catch falling babies and knives.
Yeah,
John.
avoid the other. Chief Investment Officer there, China Equities at AllianceBernstein. By the way, we can turn to your Bloomberg, by the way, for clients here on more on the China story today. TLIV Go. We have a lot on deck today. Is an understatement.
Yep, and a lot of people that we talked to in Switzerland as well, with China's post-pandemic recovery disappointing last year. One major investor says there is cause for optimism. Primavera Capital founder and CEO Fred Hu spoke to us in Davos about the possibility of a rebound in Chinese assets.
I very much hope so, and I think last year, as you pointed out, was a dismal year for the markets and for the economy. Chinese economy definitely underperformed, since the COVID reopening. However, I think the conditions are in place. The economy is going to be much stronger. Fundamentals are going to improve across the board. Above all, policy uncertainty is going to be reduced, clearly. So that they will pave the way to drive confidence, and on top of the dirty, cheap valuation across the spectrum.
Before we talk about those dirty, dirt cheap valuations, are you then saying that China is back being investable? Because we know when you take a look at foreign funds, they've either cut the exposure to China or made a complete exit from the Chinese market. Are they wrong in doing that?
Well, investors definitely saw a lot of uncertainty. They were puzzled or confused by the mixed messages from policymakers and regulators. They also saw the data, how the economy was doing, disappointing. So this combined together, they were net sellers, much of the last year. Again, right now we are at the kind of inflection point. There is evidence. The parts of the economy are improving and picking up, and I think, to me, the most important thing is the Chinese leadership has at last, grasped the, reality, understand the gravity of challenges they're facing. So I think, people don't forget, China still has a lot of arsenal, policy arsenal at its disposal, whether it's monetary or fiscal or regulatory.
Has Linda there in Davos with Primavera Capital CEO Fred Hu. In fact, just on the other side of this break, we'll have more from the World Economic Forum. And this time we're talking AI. There we go with the man himself, Sam Altman, and the future of the technology and why it might not actually be the job killer most people pretend it out to be. That comes up next. This is Bloomberg.